What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
Today I'm joined with Adi. How you doing today, Adi?
Hey, I'm fine, Dan. How's it going?
I'm great. I'm great. And let's try out your name. It's Adi Goke. Is that right?
On point. You've been calling this for a while. Now you
Yeah,
know
right.
it.
Right, exactly. And it makes me think of, Michael Jackson and Smooth Criminal, but that whatever. Anyway, I got some exciting news for you, Adi. Today we have my very favorite audience member joining us today. And why is my favorite audience member here, you may ask? Well, this is a chance encounter where I interview commercial real estate syndicators, investors, buyers, sellers, those sorts of people. And why would I do such a silly thing, you may ask? Well, if you've ever heard of an off-market deal, also sometimes called as a private deal or a 506B syndication, well, you might also know that the SEC requires that you have a prior substantive relationship, or else the SEC will get ants in its pants, and we can't have that. So I interview everybody, find out what their level of sophistication is, appetite for risk, core competencies that they want to contribute. And the benefit for you is you learn how to effectively communicate on the subject of commercial real estate. But before we get too far into commercial real estate, Adi, do you want to say a thing or two about yourself?
Yeah, I'm based out of Nashville, and I've been in the US. This is my sixth year in January.
Mm-hmm.
I built a portfolio for myself of businesses I existed um, living in Nigeria, in Africa, and build a portfolio of real estate there. It's kind of very straightforward to do it there. You get a land, you build it, and you rent it out, and you sell it when you want to sell it. So I have a portfolio of real estate back home. But yeah, here I've started with single family. I have like two renters, and I pivoted into multifamily this year. And aside that, I'm a supply chain executive. I work for one of the big tech. But yeah, a lot of new things for me in the multifamily space for sure. Yeah.
I love it. I love it. And that kind of dovetails into the distinct motivations. Before I do that, though, I have to say, but wait, check your eight. Hey, Adi, I don't know if you can see through your phone into the user's computer, but down there at your eight, somewhere around down there, there might be this awful subscribe button if they haven't already hit it. Oh, okay, now it's a silly joke. But anyway, I like to do that in every episode. Now, I've spoken to hundreds or thousands or something, a large number of investors by this point. And one of the things that I always ask for is I need to find out why exactly somebody's going to go through all the hassle of a commercial real estate deal. And when I say hassle, they take months to close, they take years to go full cycle. And so if you're going to have that kind of patience, I need to know ultimately why somebody's going to stick around. And even though everybody has their own unique why, I find that they fit in these five categories pretty neatly. So I go through all of them in every episode. The first one of which is preservation of purchasing power. What on earth is that? Well, there are people who don't have a W-2, they don't have a job. The way that they make ends meet is from the proceeds of ownership. In other words, they have a portfolio of assets and the cash flow that comes from owning them, that's how they pay their bills. And so, if that's already your situation, then why would you make another acquisition? Well, there are a few different scenarios, and the biggest ones would be if inflation is rearing its ugly head. Well, that's going to eat away from the purchasing power of your cash flow. So, it's going to be time to make another acquisition. But the other time is when there's distress in the property or an asset crash, and that makes it possible to buy at a steep discount. So that's why a lot of people make their next acquisitions. But me personally, that doesn't really fit me. What I'm up to is, because I got a background in tech. Specifically, it's the CRM industry and building web applications to do millions and tens of millions of dollars in online transactions. But and then real estate since 2014. But I was working for a guy starting in 2014 who was doing 10 single family transactions every single month, like clockwork. And I ended up finding out all of the different tax advantages you have when you do what he's up to, which is trading his time for wealth. In other words, he's going for deployed capital in return for his effort instead of salary, high wage like I was, and just giving most of it to the government in the form of tax. So that's what I'm up to, but that's a little hard to swallow, especially for youngsters. What they tend to be up to is they want to take control of their schedule. And maybe that means they want to hustle like crazy right now and then retire early. Or maybe it means they want to find something where they can work fewer months per year or fewer weeks per month or something like that. But the main thing is it's kind of a dialing back long term, and that is not everybody. Some people, they're fueled by ambition. They want to buy their entire hometown. They want to make sure that their great grandchildren never have to hold a day job, and that's why they're going to hustle into their 90s. And it basically shows it's a different type of personality, and they're a very valuable part to the team just because they're going to keep going. Just like the last one, the last group, they are similarly motivated. However, it's not going to be their own family or themselves or having their names in lights. They've picked a sector of society, or maybe it's the environment, maybe it's animals, maybe they want to send people to space. Who knows? But if you want to make a really big difference, there's a financial component to that. And so a lot of people choose commercial real estate as a vehicle to get to access to equity multiples and things like that. And that's why they're doing it. So Adi, as far as of those five different motivations go, what combination of those would you say describes you best?
I think first is just a combination of having that freedom from time, being able to move your time around, looks around that overlaps with your third one. And then I would say, freedom of time comes with that benefit for, I wouldn't call it retire early, but it's more like trading that time to do much more, right? Than what you can do in 9 to 5. Just leveraging that time and getting to the point where you're also able to help people. I feel like that gives you tools, gives you that network, that exposure to know how to multiply wealth, not just for yourself, but I would say also for like others. So I would say 3, 4, 5 out of the list looks like I would think about my whys here.
I love that. I love that. And I know a lot of people, they talk about trading time for money and the problems that come from that. But I think at the end of the day, if we're really thinking about it, it's the problem is you're trading your time for money from one entity when you're working a job. It's all coming from one source. Whereas even in apartment complex investing, you're actually changing it so that your customers, you have more of them. So I think that's a great way of putting it, how you answered that. But of course, all businesses have risk, and commercial real estate is one of the most mature ones out there. And if you've ever been involved in a 506B deal, one of these off-market deals, then whoever the securities attorney who was in the mix, they should have insisted that everybody fill out this very invasive financial questionnaire. And if there was no attorney, then that's a huge red flag. You should probably find an attorney immediately. But anyway, the problem with those that questionnaire with all the financial questions personally was once I got to the one about tolerance for risk, I felt like you wouldn't be able to get useful answers out of the options. And so I made my own one that I think gives me a much clearer idea. And it's a fill in the blanks question. It is there are many popular investment asset classes, but I think blank is too risky. So how do you, it could be inside real estate, it could be outside real estate, it can be both. What's too risky for you?
I think outside real estate, I mean, my risk tolerance varies. I need to usually understand clearly what are the inputs and outputs of expectation. So even within real estate, there will be risky deals, right? And even outside of real estate, there will be less risky deals. So, I mean, it's not just more than just one spot or class of asset is risky. I would think you need to understand the asset type, understand the deal specifically, in my mind. Anyway, stock market can be risky, right? Like it goes bust sometimes. I mean, the last 2 years, crypto can be risky, right? So I think it depends on understanding the asset class and the deal in time and the position of the market.
I love that. I'm not a big fan of stocks just because they have PR departments, which is literally a department of people whose job is to spin whatever's going on into a way that won't cause people to sell their stocks. And when you invest in Main Street in a syndication, then they don't have a PR department. So you're getting the straight goods. You get a much better, clearer picture of what's happening with your money. So that's what I like about that. But some people in this industry, they are just a pretty face and they're trying to get you involved into their circle and they are not really numbers people. And that's perfectly fine as long as the people who are underwriting the deal, the people who are really crunching the numbers, know the answers backwards and forth. And regardless from where you are in that spectrum there, uh, all of these numbers that I'm about to spout out here, as far as favorite deal metrics go, they're all important. But the main thing I want to do or achieve from this question is find out if there's somebody in the audience with a deal in their hand and a substantive relationship with you that's documented, of course. If they want to pitch you in, then what numbers really sing to you the most? So for everybody in the audience who has their video off, or if the screen is too small to read what's on here, I'm going to help everybody by reading it out. So the metrics that you depend on most, is it cash on cash, IRR, cost per door, NOI, which is net operating income, going in cap rate, loan interest. So that would be especially for the cheap loans that were from a few years ago that have long periods still left on them. That becomes important. Next is occupancy. In other words, what's the vacancy rate? Average income in the area where the property is located, amortization period of the loan, the difference between the market and the in-place rents, the population growth where the property is located, the sponsor record, which that would be how many deals have gone full cycle, how many deals are in play, and what's the performance. There's the waterfall or the split as far as what happens after all of your capital is returned. And then the debt service coverage ratio. Those are the ones that I have on there. It's not a complete list, but on there, or if there's some that are off the list, which ones do you focus on first?
I mean, from my underwriting point of view, I would usually make sure like every asset I'm going into, or if it's a deal, because we're taking it with some equity from the bank, right? I want to make sure the DSCR is good. I have that 1.24 litmus test for my DSCR. If it's like, multi-family deals, I like to understand the NOI and the cap rates. putting that two together, what's the going in cap rate, and see if we're holding it for 5 years, 7 years, what's the exit cap rate, and understand what's the value add, what's going to be the exit. So all of that will then drive some of the outcomes here you have, right? Whether it's the cash on cash, is the IRR, and some of those things. So first, for me, it's usually what the deal is like, understanding those input. I think the other things here are mostly like really output. I like to hear about the sponsors record also, for sure, qualitatively. Want to know how many deals they've done, how many deals they've exited, what's their stay power, what's their resilience, managing assets. You got to earn that trust also. So kind of how I would look at these metrics and, some of the other things you've thrown out there.
I love it. I'm eating up that answer like a subscribe sandwich. That thing just kills me every single time. It's not a very subtle reminder that I had to pull out the Dan Does Deals Commercial Core Competency Cube, and it has the 6 different roles in a commercial real estate deal in it. And the reason why I go through all 6 sides in every episode is because I want you to be able to effectively communicate on the subject of commercial real estate. And I also want you to be able to understand how my guest fits into these deals. And if you absolutely fall in love with these cubes, if you go to dandoesdeals.com, there's a little button you can click on to download and print out your own copy. And like a complete dummy, I don't even ask for your email address. That's a really, really bad thing from a marketing perspective. It's like the cardinal sin. You should always ask for some sort of contact information in return for your freebie. But let's get started, because it's so important to be able to be super duper clear with what each person in a commercial deal does. So let's start with acquisitions people. They're called repositioners. What's a repositioner? What is all this paperwork they're doing? Well, they're looking at lots of different deals and they're underwriting them. That's the fancy word. It means they're doing the math, they're doing the arithmetic, they're doing the projections as far as what's going to happen in the future, but they're figuring out their repositioning part is how are they going to change how this business is run so that there's more upside. And one way that it's a little bit peculiar, even when you're first getting started, repositioners have to have a vast network of financiers, okay? And financiers, they're not on the GP team. They're not general partners. They're going to have no part in asset management. They only deal with paper and money and people, I guess, but not tenants. So the financiers are always going to be a big part of a repositioner's business, because if the repositioner can secure a more advantageous loan, that's going to go straight to the profitability of the building. So the repositioner is going to have financiers in play, and then of course they're going to look at operations and think, how can we stop those Benjamins from going down the toilet? But of course there's more to operations than just unclogging toilets and collecting rents and mowing lawns. And if you're like me, I like deals where it's 100 or more units, and that's because we can outsource to a third-party property management company, and then we're just doing asset management. But then the question is, I don't know if you know this about me, but I'm from the internet. So what that means is I have to have some sort of way to contribute to these deals and these teams in order to be legally allowed. And the boxes that I check, one of them is automation, and then web applications and social media and all that kind of fun stuff. But if you understand that vacancy is the real enemy in this industry, then somebody on the GP team in operations needs to be able to step in and fill those units, even if the third-party property management isn't doing their job. But of course, operations, there's only so much you can do. So the next place the repositioner is going to look to find more upside is they're going to get contractors involved to do some upgrades, some value add, especially in multifamily. That's most of my guests on here. But of course, the contractors, you don't want to have them gold plating the toilets, because there's going to be no return on investment. But there's plenty of other ways to lose money on contractors, like if they drag their feet or use subadequate materials and things like that. So if you're like me and from the internet, then you're going to need a local. You're going to need boots on the ground, somebody who can be there in an hour or two, because that's not going to be me. I'd still be stuck at an airport in an hour or two. So that's the local keeps an eye on the contractors, keeps an eye on the operations. And then when the repositioner has this perfect property in mind and they have this team assembled, they turn around to the financier and it goes a little bit something like this. Let's say you're an attorney or a physician or an engineer, something like that, and you decide you and your circle of friends are going to take over a property. So you turn around to the financier and say, hey, this property is 350 units and it's tens of millions of dollars. Want to lend us, I don't know, tens of millions of dollars? Well, the financiers are going to have one question on their mind, which many mentorship and guru programs, they really, really gloss over. And what it is they're going to ask, who's your sponsor? Who's your KP? What's that all about? Your team is not going to be eligible for a commercial loan unless somebody in the fold already owns a similar asset. So that means if you want to take over a 350 unit apartment complex in the middle of your town, somebody in the fold has to already own a 350 unit apartment complex, or else the bank's going to say no. But if you have that, you have a certain amount of liquidity and a balance sheet of at least the amount of the loan, you got yourself a commercial real estate deal. So, Addy, as far as these different roles here, like you mentioned, the underwriting piece of the puzzle that you're up to, so that makes you a type of repositioner. But what other boxes do you really focus on?
Capital raising, and that's the other part I'm trying to, build a network on, understand the intricacies, have a good funnel, because I think I do
Mm-hmm.
have the ability to talk to folks to understand what is in it. But again, this is a place that is also tricky because
Mm-hmm.
there is some legality, there is, requirements. You have to build that relationship. You have to tick all the boxes. So yeah, that would be the other place. I don't know where to put it in your six cube
Yep. Yeah.
place.
That's a financier
But
role. Yep. That's a financier.
okay, that would be
Yeah.
fun. I say.
Okay. All right. Great. So then the next question then has to do with buy box. And when real estate people are asking, hey, what's your buy box? What's your ideal property? We're asking them about three main things. First one's geography. Where is it? I know Addie's in Nashville, but as far as states, that's going to be important. It probably is going to need, we're probably going to need to know the county. We might even need to know the neighborhood. So that geography is definitely going to matter. The second one's size. And most of my guests on this show are in multifamily, which is apartment complex investment. And the way that you define size in multifamily is by unit count. It's important because the type of group that's going to take over 10 or 15 unit apartment complexes are going to be completely different from the ones who take over 100, 150, 200 unit apartment complexes. So that size definitely matters. The third one, I'm going to call it desirability. Most people call it class. I'm not crazy about the term class because it's two separate things. The first one is the condition, the second one is the area. And when you're talking about condition, it's how beat up is the building? How old is the building? How up to date is the building? Is it, is it a really no frills or, maybe even somewhat dangerous sort of place? Or is it a place that you actually enjoy being at? And when you're talking about the area, it's again, when you're talking about multifamily, the school districts are going to matter. But regardless, the crime rate is going to matter. But if they say location, 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 what they really mean is traffic, traffic, traffic. So with every type of real estate, it's going to be more desirable if more people pass by on any given day. But both that area and the condition, they're both ranked the same way as in grade school. So you got A plus at the top, and then A, and then A minus, and then B plus, and so on. So Addie, as far as you and your group, what would you consider ideal for your buy box?
So it's a split of two. I have a challenge going on, 100 days to 100 door challenge, and our buy box is we're trying to get 100 doors in 100 days. That's the count of the unit. Location wise, we're looking into um, the Dallas area. We've made offers, LOIs out in Indiana, specifically. I think Greenwood MSA is one specific MSA we're interested in. We're also pivoting and also trying to just make sure our acquisition team is focused in Columbus, Ohio, and then Louisville, Kentucky. Um, we have boots on the ground in Springfield, Massachusetts. They've acquired some type of assets. So we have sponsors in the team also. So that's where we have boots on the ground, but then there are other. I think the big thing when it comes to asset class for us is looking at um, uh, the picture of B and C's, right? Whether it's like a C class, C plus asset that is that is a B type, no, C plus area that's a B type asset, or whether it's a switch off. I would say it's a permutation of C's and B's for us, right? As long as like you would have that, it's in the upward trend, kind of, things are moving in the right direction in that area, and there's opportunity. I think from a year point of view, we're looking at 19, I think 67, whenever the aluminum wiring thing, whatever that cutoff was, would be where
Yeah.
we're looking at to make sure that we're able to secure insurance at a very good rate and minimize risk from an insurance point of view. And I think personally, I can also sponsor deals with my core team, not the 100 team. So for that, we're looking at anything in the less than 5 million buy box. We're looking at, $50, less than $50 for that one, because we also want to make sure we hold assets that we can also sponsor straight out of the bat if we understand it. So those are like more smaller units. But for a larger group point of view, I think my capital partner teams are trying to work with that 100 days to 100 dollars buy box.
I love it. I love it. So let's talk about people then. My favorite thing about commercial real estate has to be the fact that because it's multifaceted, there are these different roles in here. Nobody's going to be all six of these roles for any real amount of time, and everybody eventually is going to hone in on one or more. It might be more financier relations, and then they have some sort of asset management gig going on. Who knows what it is? You have to have some sort of role in it. But even though everybody is so eager to build new teams because they're only part of a puzzle and they want to see each other succeed so that they can partner up in the future. Because we all have our own unique skill sets, though, we're better off or more apt to help some people more than others. I've always been looking for more sponsors and KPs just because they are the people who already have a real estate foundation figured out. And so that way I can really make a disproportionately large difference. When you're first talking about a local or a repositioner, you need people who can just put in the hours. It's the 80 to 120 hour a week crowd that they really need to build their business. But once you have that foundation and you're a sponsor, a KP, then when people are involved and they can tweak 1% to be worth way more than a salary, then it makes more sense to get somebody like that involved. So that's where I throw my hat in the ring. But Adi, where do you fit on this? And also, if you have any 506B deals, make sure you don't mention it, because if you mention investors or
I do not
financiers.
have a private placement deal yet, so that's fine. But where do I see myself? I think I'm trying to make sure I spend the next few months, and a few months might be a good part of this year. I spent the last part of last year underwriting deals because I feel it's like the foundation. You need to understand your numbers before you go be raise fund, right? Like you need to be bought into it. And having numeric, I'm numeric, I lead a data and analytics team. So I stay with the numbers, right? So I think I see myself in the long term pivoting from just that to the raising capital the more. Because I also want to sponsor deal. That's my big mindset. At the end of the day, that's where I want to go to in the value chain. But I want to work my way up. that.
I love it. I love it. And then that brings me to how to reach out. Me, I'm lucky that I got this distinct last name and it's 100 miles long and it makes it super easy for people to find me on LinkedIn, which is the social media platform where I spend most of my time. So that's the best place to catch me. But of course, if you have your phone handy, you can scan this QR code right there. That'll bring you to the FAQs page of 506BME, which is the platform where I offer the service of documenting your substantive relations so that when the SEC audits you, you've got that in place, even if you accidentally drop your laptop in the bathtub. Basically, you're responsible to show proof that you knew people before you involved them in your deals. So that's something that I have on offer for everybody. Addy, if people want to reach out to you, it could be social media, email, phone. How should people reach out?
Well, they can reach out to me on LinkedIn. It is ADEGOKE space FALAIYE. ADEGOKE space FALAIYE. It's your nickname. You can't get to that much. And then on email, it's adegokesworld@gmail.com.
All right, I love it. I love it. And that brings me to the last part of this show, which is the public service announcement. It's not for you, Addie. It's for the people in the audience. If you've been watching this episode of Chance Encounters and you've been experiencing searing pains in your eyeballs and like migraine like symptoms, it's probably because of the downright hideous subscribe button. And that's right there. And you can get rid of it for free. You just click on it and it goes away. It doesn't cost you anything. And I'm biased. I want a lot of people to click the button because then YouTube will start to pay for these videos instead of me. And I think that would be amazing. And the trade-off to you, just so we're clear, it's my videos might show up on your list of suggestions, but quite frankly, you can go ahead and ignore those suggestions. I just appreciate the fact that you spent this time with me. Just like Addie, I appreciate you joining me today. This has been great.
All right, then.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a Chance Encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute Chance Encounter format, it checks both of those boxes and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Make sure you 506B me. Any syndicators, make sure you 506B me. Hi. Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser. Okay. Are you already logged into 506BME?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506BME, everybody.